An exchange-traded fund, ETF for short, is an investment fund that lets you buy a large basket of individual stocks or government and corporate bonds in one purchase. Think of ETFs as investment wrappers, like a tortilla that holds together the component ingredients of a burrito. But instead of tomatoes and rice and lettuce and cheese, these burritos are filled with stocks or bonds and are considerably less delicious to eat with salsa. In this video, we are going to explain ETFs and how they work. An exchange-traded fund, aka ETF, is a group of securities that you can buy or sell via a brokerage company on a stock exchange. These underlying securities tend to represent an economy or a sector, so it's a way for investors and traders to invest in economies or sectors they are interested in without having to pick individual stocks and at much lower costs than mutual funds. While the above describes the most typical scenario of an ETF structure, it is possible that an ETF also tracks a single index, individual commodity, or so on. There are many more types of ETFs to choose from, including bonds, currencies, and new growing markets such as biotechnology, artificial intelligence, and as of very recently, the first official Bitcoin ETF, the ProShares Bitcoin Strategy ETF. ETFs give traders and investors the opportunity to speculate on or invest in a sector, rather than choosing individual assets. For example, you may have recently heard a lot about the growth of AI, artificial intelligence. However, you may not know how to find the right company to invest in since it is still a very new area. This ETF in particular seeks to invest in companies that can benefit from advances in the development of robotics and artificial intelligence. Therefore, it can provide the investor with access to a growing market, without having to choose a company individually. The origin of ETFs. As a product, ETFs were created in the US 1993 when Nathan Most and Stephen Bloom developed Standard & Poor's Depository Receipts, SPY. Economist Harry Markowitz was one of those who laid the first bricks in the creation of the exchange-traded fund. His idea was to introduce a publicly traded fund that was related to the world's most popular index, the S&P 500. Known as SPDRs or SPDRs, the fund became the largest ETF in the world, now having a value of more than $43.3 billion. On US stock exchanges alone, there are nearly 1,000 ETF products with around $1 trillion invested in total. In 1996, iShares debuted in ETFs globally, selling ETFs on a wide range of European, Asian, and American indices. Thus, iShares established themselves as having the largest variety of ETFs, with more than 300 options for traders and investors. This caused a domino effect in terms of the emergence of new ETF instruments that could be traded and to which the common investor could have access. The success of stock ETFs encouraged the industry to launch one related to gold, and in 2004, Gold SPDR was launched. How do ETFs work? Just like company shares, ETFs are listed on stock exchanges and can be bought and sold during trading hours. Also, like listed stocks, an ETF will have a ticker symbol in intraday prices. Where they differ from company stocks is that the number of shares available in an ETF can change daily. As a result of the continuous creation of new shares, and redemption of existing shares in the ETF, the market price of an ETF is usually kept in line with its underlying securities on an ongoing basis, due to the ability of an ETF to issue and redeem shares in itself. In short, ETFs, they are traded like equities, which makes their prices visible in real time. They can be sold or purchased at any time during trading sessions. They are a single instrument that contains several trading instruments, including shares and fixed income securities. They are not exclusively available to corporate investors or large participants in financial markets. Generally, ETFs are outstanding investment choices. They can be bought and sold in real time and have lower management fees than ordinary funds. For these reasons, ETFs are also starting to replace mutual funds as the default investment vehicle. That wraps up the video. I hope you enjoyed it, and if you did, make sure to give it a thumbs up. Subscribe to our channel and don't forget to press the bell icon to stay notified about our uploads.